3 high dividend stocks you can count on. It's easy to chase high dividend stocks and even easier to lose money on them if they fall. There's a better way to find high dividend yields you can count on to make you money, which includes stocks like materials company Rio Tinto and financials like Crown Castle plus Alliance Bernstein. All things held equal, when a stock falls, the dividend yield rises. In other words, if you own a company with a massive yield that's rising, you're likely losing money on the underlying stocks. That's not a successful long-term strategy. It's actually a common way to lose money. What's an investor looking for high dividend stocks to do then? Find stocks with market-beating yields and shares that at least keep pace with the market long-term. That way you get a rich dividend that isn't eroded by a faltering stock price. To help you find such opportunity, investors business data pinpoints high dividend stocks that yield at least 3%, which is more than double the Standard & Poor's 500's yielding roughly 1.3%. But just as importantly, they have a stock price that at least keeps up with the market. High dividend stocks, math distorts reality. A rise in dividend yield may simply be masking a money-losing stock. Math and the way dividend yields are calculated is why this happens. The formula for dividend yield is dividend yield equals annual dividend divided by stock share price. Why does this equation matter? A falling stock can make a dividend yield look great. Now let's say you buy a $30 a share stock that pays $3 a year in dividend. You might be initially thrilled with your impressive 10% annual dividend yield. That's $3 dividend divided by $30 stock price. The stock yield is 500% larger than the S&P 500's roughly 1.3% yield. Now, the stock crashes to $15 a share and the company holds the dividend the same. Applying the same formula, or applying the same dividend yield formula, the stock dividend yield doubles to 20%. Looks great, doesn't it? But wait a second. Despite the higher yield, you're worse off because you've lost $15 a share on the stock. It would take 5 years of $3 dividend payment just to break even on your stock loss. This is why chasing yield is often a bad idea when looking for high dividend stocks. High yields are often a mathematical distortion of a declining stock. Chasing yields can cost you money. Losing money on a dividend-paying stock is not just a theory, it's a common occurrence, especially in a rough period for stocks when you're looking for stability. In fact, 405 stocks on the S&P 500 paid a dividend going into 2020, says S&P Global Market Intelligence. Of those dividend-paying stocks, 167 or 40% saw their shares fall enough during the year to wipe out the entire year's dividend yield, or worse. And that's in a good market for the S&P 500. Nearly 2/3 of dividend stocks dropped by more than their yield in the last bullish 2018, and in 2019, 9% of the S&P 500 stocks that paid a dividend coming into the year are down more than that yield. Take Occidental Petroleum, or XY, up until recently one of Warren Buffett's high dividend stock darling as an example. The stock yielded 7.7% going into 2020. Shares of the energy company dropped 50% though during the year. Additionally, the company slashed its dividend. That left investors with a net loss of more than 50%, even with the remaining paltry 0.2% dividend. Keep in mind though, too, companies paying high dividends can cut them when the business wanes. Occidental did that in 2020. Ford cut its historic dividend in the first quarter of 2020 to nothing, down from the 15% a share it paid previously. Ford's dividend yield was 6.5% in early 2020, it's just 2.3% now. High dividend stocks. High dividend yields of 3% plus, that's more than 100% higher than the S&P's 1.3% yield. 3 and 5 year earnings growth of 10% plus. Earnings stability of 20 or better. Earnings stability is measured by looking at how much earnings per share swings from the 5-year trend. A lower number indicates more stability. No cuts to the dividend, which will be harder to find after 2020. So if chasing yield doesn't work, what does? One IB's strategy looks for high dividend stocks with signs of stability going for them. Specifically, these stocks have. Finally, stocks also must have an IBD composite rating of 65 or higher out of a possible 99. This means the stock and the fundamentals outperform 65% of all the stocks in IBD's database. You might think no stocks can clear all these hurdles. Actually, 6 did. High dividend yield winner, Rio Tinto. When you've narrowed down the list of high dividend stocks this much, it's okay to look for the top dividend yields. That title goes to Rio Tinto. Based in London, Rio Tinto mines and processes materials ranging from aluminum to copper and diamonds. and its yields a lucrative 8.7%. Additionally, the company's yield is up more than 31% over the past 5 years, but it's not just a high yield wonder. True, the stock is down nearly 9% in the past 52 weeks. Commodity prices continue to swing as the economy slowly reopens, but the stock has still outperformed the S&P 500 by 35% over the past 5 years. And it's a stable company. Earnings have grown more than 34% over the past 5 years and by 31% in the past 3. All this in the perfect IBD composite rating of 99. Solid source of dividend yield. Crown Castle. Crown Castle continues to be a rock-solid source of dividends you can count on. Based in Houston, Crown Castle rents a variety of commodity or communication facilities like cell towers. The stock shares yield 3.5%, well above the market shares of Crown Castle are above 87% over the past 5 years, or roughly 2% better than the S&P 500. Earnings grew at a 30% annualized clip the past 3 years and are stable. On top of this, the company boosted its dividend by more than 8% the past 5 years. Now, that's a reliable dividend. Asset management flexes its dividend power. Historically, asset management firms show why durable earnings coupled with dividend yields can be a powerful combination. AllianceBernstein is a case in point. The New York-based firm's 8.2% dividend yield calls out to income-seeking investors, but our analysis shows there's more to it than just a market-beating payout. Roughly 10% earning growth in the past 5 years and 18% earning growth in the past 3 shows the money manager is tapping new routes of expansion. The most promising thing is the firm is committed to dividend growth. AllianceBernstein boosted its dividend 11%. All this at an acceptable IBD composite rating of 70.